Today, we're diving into the fascinating economic story of Nepal. Now, on the surface, the country looks remarkably stable. But if you look just a little closer, you'll see its central bank is in the middle of a very high-stakes balancing act, and the outcome has huge implications for its future.
So, here's how we're going to break it down. First, we'll unpack that core economic paradox. Then, we'll get into the bedrock of its stability, the remittance safety net. After that, we'll look at the central bank's delicate balancing act and the tools it's using. We'll also cover the hidden risks brewing under the surface. And finally, we'll explore the path forward.
All right, let's start with just one number. A single data point that, on its own, would make you think Nepal's economy is incredibly strong. $17.63 billion US dollars. As of mid-April 2025, that's the size of Nepal's gross foreign exchange reserves. Now, to put that in perspective, that's enough cash to cover over 17 months of everything the country imports. The normal international benchmark is maybe 3 to 6 months, so they are way, way above that. And this brings us right to the heart of the paradox. If the country has such a massive financial cushion, then what's the problem? Why is its central bank walking such a fine line with its policies? That's really the core question we're digging into today.
Well, the answer really starts when you look at where all this money is actually coming from. It's not being generated by a booming export sector or a flood of foreign investment. The entire foundation of Nepal's stability rests on one thing: remittances. And the scale here is it's staggering. The money sent home by Nepalese workers abroad completely dwarfs every other source of foreign cash. I mean, to put a number on it, they brought in $8.74 billion in just 9 months of the 2024/25 fiscal year alone. This inflow of cash has immense power. It covers more than half of the country's huge trade deficit. It makes up about a quarter of the entire economy. And for over half of all households in Nepal, it's their main source of income. This money is the safety net that's keeping the whole economy afloat. Okay, so with that context, now we can really understand the central bank's core dilemma. It's basically a constant tightrope walk between two needs that are pulling in completely opposite directions, but both are critical for the country's stability. See, on one hand, the government is incredibly dependent on imports because the taxes on those imports, customs duties, make up about 40% of its total revenue. So allowing more imports keeps the government funded. But on the other hand, restricting imports is crucial to protect those foreign reserves we just talked about and to try and support local industries. It's a fundamental choice. Which direction do you go? So how does the central bank, the NRB, even begin to navigate this? Let's take a look at the specific tools they're using right now. For the current fiscal year, the NRB has officially described its policy as cautiously accommodative. Now, that's central bank speak, but what it really signals is a clear pivot. After a period of tightening things up, the priority has now shifted to stimulating the economy and trying to create growth. And this isn't just talk. They've already taken action, cutting key interest rates, like the bank rate, by 50 basis points. The goal here is pretty simple. Make it cheaper to borrow money and give banks an incentive to start lending again. The NRB has also set some very specific targets for this policy. They're aiming to grow private sector lending by 12.5%, help the government hit its 6% economic growth target, and all while keeping enough foreign reserves to cover at least 7 months of imports. But, and this is a big but, trying to stimulate an economy while these deep structural issues are still there, well, that comes with some serious risks, and we are starting to see some major cracks appearing in the system. One of the biggest red flags right now is the alarming rise in non-performing loans, or NPLs. These are basically bad loans where people have just stopped paying. The NPL ratio has shot up from just 1.3% to a record 4.9% in about 2.5 years. That's a huge threat to the health of the entire banking system. Beyond the banks, there's an even deeper, more structural risk at play here, something economists call Dutch disease. It's what happens when a huge inflow of foreign money, like all those remittances, makes a country's own currency stronger. The side effect is that it makes exports more expensive for others to buy. and makes imports cheaper, which can really hurt domestic industries. And you can see the symptoms of this all over Nepal. The economy is dominated by people buying imported stuff. Productive sectors like farming are starved for investment. Workers are leaving manufacturing jobs, and the service sector has ballooned to over 62% of the economy. So the very money providing stability is also, ironically, weakening the country's long-term ability to produce things. Which brings us to the final part of our analysis. Given all these challenges, what does the path forward look like? And is the central bank's current strategy actually working? Well, here we see a pretty clear gap between the goal and the reality. While the NRB cut interest rates to try and hit 12.5% credit growth, the actual growth is stuck down at just 8.3%. So even though money is cheaper, weak demand and nervous banks are holding back lending. And this really gets to the heart of the problem. You see, monetary policy, things like cutting interest rates, it just can't fix these deep structural barriers on its own. Things like low productivity, a tough climate for investment, banks being cautious because of bad loans, and those effects of Dutch disease, these are all getting in the way of real, sustainable growth. And that leads us to the ultimate takeaway here. Without the government stepping up to tackle these fundamental issues with real structural reforms, the central bank's efforts are always going to have a limited impact. For this to really work, you need a coordinated effort from everyone. So it leaves us with this one big question. In an economy that's so reliant on money from abroad and is facing these deep-seated structural challenges, what are the true limits of a central bank's power? That's the question Nepal's policymakers really have to grapple with as they try to navigate the path forward. This has been an analysis from Alpha Business Media.